Most retirees think of their IRA as their own money, but you have a silent partner in the IRS and the taxes that you could pay on that if you're not planning ahead for your required minimum distributions. I've got the 4 most common mistakes people make when they fail to plan ahead for their RMDs. That more coming up. You spent 40 years building your retirement nest egg, your 401k, your IRA, and if you're not careful, the IRS could become the biggest beneficiary of those dollars. That's right. You've got to be taking a proactive approach to manage and plan ahead for your future required minimum distributions. Just got a question from a fan of the show about, hey, I don't understand required minimum distributions. Can you help me explain who does the calculation and how it works and how do I pay tax on this money? Can I reinvest it? And oh my goodness, I was able to answer that and work through it all, but it just got me thinking, if only she would have reached out sooner. If only this fan of the show would have reached out a few decades ago and had been working with a certified financial planner, the answers could have been much different. Because the answer at this point, she's near her required minimum distribution age, which is why she's asking. And I shared that, yes, there's a calculation that your certified financial planner is going to do each and every year. It's going to be based on your pre-tax or your IRA balance as of 12/31 of the previous year. They're going to divide that number. It's a life expectancy factor that's published out there. And so they divide that and they come up with, well, here's the amount that you are required to draw out of your pre-tax retirement account, your IRA or what have you. You can draw out more, but you at least have to draw out this amount. This is the IRS's version of saying, listen, you have delayed and deferred the taxes on this money for too long. We're going to force you to start taking this money out so it can land on your tax return so that we can tax it. And if you haven't been planning ahead, what that means is it could increase your tax bill. It could increase other expenses, what you pay for your health insurance. It could have other consequences that could end up meaning dollars are slipping out of your fingers and going to Uncle Sam. What are the 4 biggest planning mistakes that we see people make when it comes to not planning ahead for the required minimum distributions? Number 1 is not taking advantage of the gap years. Not taking advantage of the gap years. I'm not talking about the transition between high school and college. No, the gap year in this instance is between your working career and the time when you're forced to start taking a required minimum distribution. Right now, currently, RMDs, you have to start taking that withdrawal at age 73. In a few years, it's going to move to age 75. If, let's say, you retired at 65, between 65 and 73, that's your gap year. Those are the gap years. That's your time to optimize your tax picture to plan ahead for your future required minimum distributions. If you haven't been doing it throughout your career, leverage that gap year to do Roth conversions, to take extra dollars out, to pay the most amount of tax at the lowest possible bracket. So if you're in the 12% tax bracket and when you calculate your required minimum distributions out there in the future, that's going to push you into the 22% tax bracket, doing Roth conversions now to fill up that 12% tax bracket to pay as much tax as possible at those lowest possible rates at that 12% rate so it can avoid being taxed at the 22% bracket out there in the future. So managing those gap years, taking advantage of those gap years, plan ahead to reduce your RMDs during that time period. Second biggest mistake is by not planning ahead for your required minimum distributions during your career, not planning ahead during those gap years, it can create an unforced error where you have a Social Security tax torpedo or push you into IRMA, income-related monthly adjustment amount. Failing to plan ahead for your required minimum distributions can cause both consequences. So when you're on Social Security, when you're collecting Social Security, is your Social Security taxable? Well, it depends. It depends on the calculation. That calculation is all of your other income plus half of your Social Security. All of your other income plus half of your Social Security. And if that formula equals a number that's greater than $25,000 if you're a single individual, then some of your Social Security starts becoming taxable. If you're married filing jointly, then that threshold that it needs to exceed is $32,000. So these are not big numbers, guys, and they've never changed, by the way. So then some of your Social Security starts becoming taxable. Well, before you start taking your required minimum distribution, if that formula yields a very, very low number, then very little of your Social Security is being taxable. And that might feel temporarily like a really good thing. But then when you start your required minimum distributions, if that all of a sudden pushes that formula up to a much, much larger number, such that the maximum amount of your Social Security is taxable up to 85%, that can mean you're paying a lot of tax all of a sudden and without any warning and for the rest of your life, because those required minimum distributions have to occur every single year. So failing to plan ahead during your career and during those gap years for this potential Social Security tax torpedo can cause that egregious amount of tax. But then it can also cause IRMA, income-related monthly adjustment amount. What you pay for your Medicare Part B and Part D is based on your income from 2 years ago, the prior year rule, okay? And these are much higher limits than those Social Security tax formulas, but if your income is above certain thresholds, modified adjusted gross income thresholds, then you pay a surcharge above and beyond the base rate, which is currently for this year, $202.90 per month per person. You may have to pay double that. You may even have to pay triple that if your adjusted gross income, modified adjusted gross income, is above certain levels. Well, once you reach this required minimum distribution age, if you haven't been planning ahead, then your RMDs are much higher than they otherwise would be, pushing your income up potentially above that IRMA threshold or even into other tiers where now you're having to pay more for your Medicare Part B and Part D than you otherwise would. The third mistake that we see a lot of when people have not been planning ahead for their required minimum distributions is poor investment location, okay? Poor investment location. And that is, with your required minimum distribution, you've got to pull that out of your IRA, of your pre-tax retirement account. Which investments do you pull it out of? So frequently people aren't thinking. They just view the required minimum distribution as just a checkbox. I've got to check this off. Let me just draw it out. And there isn't intentionality around, well, am I selling the bond investments or the low risk investments in my portfolio? Am I selling the medium risk investments? Am I selling the high risk investments? And it really needs to depend on what's going on in your financial life, your financial goals, and certainly within the overall economy and stock market. You need to be intentional. And if you haven't been planning ahead for your required minimum distribution, then your RMDs are likely going to be an even bigger amount and therefore could create an even bigger problem if you then pull your required minimum distributions out of the wrong investments within your IRA. And then finally, the fourth mistake that we see a lot of people make when they're not planning ahead for their required minimum distributions is if they're also charitable. And that is missing the qualified charitable distribution window. And it's now called a window because it used to just be an opportunity, but it's both an opportunity and a window. So if you are making donations to the church, to a 501c3, then when you turn age 70 and a half, you are able to do a qualified charitable distribution where you're able to donate dollars directly from your IRA directly to that end charity. It comes out of the IRA, goes direct, do not pass go, do not, collect $200. It does not go to you. It goes directly to the charity. And when it does that, it's a withdrawal, but it's not taxable to you. And I'm not talking about that it lands on your return and then you get a charitable deduction. I mean, it doesn't even land on your return. Comes out of your IRA, doesn't land on your return. Therefore, yes, it doesn't count against you for that Social Security tax calculation, doesn't count against you for IRMA. Yet, it does count towards your required minimum distributions. But note, the age 70 and a half, that it was hard-coded into the Internal Revenue Code. So when they shifted the required minimum distribution age from 70 and a half to 72, now to 73, in the future to 75, the QCD, Qualified Charitable Distribution age, remained 70 and a half. Therefore, if you want to reduce your future required minimum distribution, i.e. reduce how much is in your IRA, starting to do required minimum distributions immediately as soon as you're eligible can help reduce your required minimum distribution. That's managing that window. And then leveraging that opportunity when you do reach that required minimum distribution age and doing your QCD first, qualified charitable distribution first, and then taking the remaining amount left over. So, are you planning ahead for your required minimum distribution. I want you to avoid these 4 common mistakes. More importantly, I want to make sure that your RMD planning is connected to all 6 areas of your financial life. It's going to touch your present financial position, your cash flow, even your giving strategies, right? It's going to touch your protection planning. We talked about the surcharge with Medicare and Medicare Part B, Part D, right? So it's going to be connected there. Certainly, this is all taxes. So tax planning, obviously, you want to avoid that mistake of withdrawing the wrong dollars or selling the wrong assets, the wrong investments. So investment planning, obviously retirement planning and estate planning. This planning for your required minimum distribution touches all 6 areas of your financial life. You got to work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.